In the next few days, one decision inside a quiet room in Washington could send shockwaves through the gold and silver markets. Millions of investors will watch the headline, they will look for one sentence, they will wait for one number, and many of them will make the same mistake. They will focus on what the Federal Reserve does, instead of understanding what the decision is actually telling them. Because the truth is this: the Fed announcement itself is not the entire story. The real signal is hidden underneath. And if you own gold or silver, if you have spent years building your savings, if you are trying to protect your wealth from forces you cannot control, then understanding that hidden signal could matter more than the headline everyone else is watching. So before the Federal Reserve speaks, before markets react, before emotions take over, you need to understand what professional investors are already watching. Because when the crowd sees panic, institutions look for opportunity. When the crowd sees one scary headline, experienced investors look at the bigger picture. And that bigger picture begins with one simple question: why does a Federal Reserve decision move gold and silver in the first place? The answer comes down to something every investor understands: opportunity cost. Gold and silver are unique assets. They have existed for thousands of years. Kings owned them. Nations stored them. Central banks still buy them today. But there is one thing gold and silver do not do. They do not pay interest. A gold bar sitting inside a vault does not send you a monthly payment. A silver coin sitting in your safe does not generate income. And during periods when interest rates are high, that creates competition. Because investors have another choice. They can own metals, or they can own assets that generate yield: a government bond, a savings account, a money market fund. When those alternatives offer attractive returns, some investors ask a simple question: why hold something that pays nothing when I can earn income somewhere else? That is why higher interest rates often create pressure on precious metals. High rates make holding gold more expensive. Lower rates remove that pressure. This relationship is one of the most important things every gold and silver investor needs to understand before the next Federal Reserve decision. Because the Fed is not just deciding interest rates. It is deciding the environment that determines how attractive precious metals become. But here is where most people get confused. They believe the market only cares about one thing. Did the Fed raise rates? Did the Fed cut rates? Did the Fed hold steady? But professional investors know the market is not reacting to the decision alone. It is reacting to expectations. A decision everyone expects can already be priced into gold and silver before the announcement even happens. The surprise is what moves markets. And that is where the hidden signals begin. The first signal is not the rate decision itself. The first signal is what the Federal Reserve believes comes next. Because a central bank can hold rates today while preparing the market for something completely different tomorrow. A pause can be peaceful, or a pause can be a warning. The difference is in the language, and that language matters. This is something legendary investors understand, including people like Jamie Dimon, the longtime CEO of JP Chase. Dimon has repeatedly warned investors that markets can become too comfortable when conditions appear calm. His message has always been centered around preparation, not prediction. Because the biggest financial mistakes usually happen when people believe yesterday's environment will continue forever. The economy changes, inflation changes, interest rates change, and investors who survive difficult periods are usually the ones who understand that markets move before the majority realizes what is happening. That is why the next Federal Reserve meeting is not just about today, it is about the months ahead. The question gold and silver investors need to ask is not, what did the Fed do? The better question is, what does the Fed's decision tell us about the future path of money? Because money has a direction. Capital flows somewhere. When investors believe inflation is falling and rates are coming down, money often searches for assets that can protect purchasing power. That is where gold becomes attractive. When investors believe rates will stay higher for longer, the pressure increases. That is the battle happening right now. A battle between two powerful forces. On one side, the Federal Reserve fighting inflation. On the other side, a financial system carrying record levels of debt. And this is where the story becomes much bigger than one meeting. Because beneath every rate decision is a much larger question. How long can high interest rates continue when governments around the world are carrying enormous debt burdens? This is the question many long-term investors are watching. Because a short-term Fed decision may move markets for days, but debt, inflation, and currency confidence can shape markets for years. And that is why the smartest investors are not only watching the Fed, they are watching what the Fed is fighting against: the economy, inflation, the bond market, and the growing cost of borrowing. Because eventually, every central bank faces the same challenge. How do you control inflation without damaging the financial system? That balance is where opportunities and risks are created, and gold and silver investors are standing directly in the middle of that battle. So as the Federal Reserve prepares to speak, remember this: the loudest signal will be the headline, but the most important signal may be hidden underneath: the language, the expectations, the future path. Because markets are not moved only by what happens today, they are moved by what investors believe happens next. Now that we understand the foundation, we need to look at what actually happens after the Federal Reserve makes its decision, because the market reaction is rarely as simple as people think. Many investors believe there are only two outcomes: the Fed raises rates, gold falls; the Fed cuts rates, gold rises. But real markets are not that predictable. The reaction depends on the message behind the decision, and that message can come in several different forms. The first scenario is what many investors expect: a Federal Reserve that keeps interest rates unchanged. At first glance, this may appear to be a neutral event, but the market will immediately ask a different question. Why did they hold? Did they hold because inflation is finally cooling, or did they hold because they are waiting for more evidence before making their next move? How long can high interest rates continue when governments around the world are carrying enormous debt burdens? This is the question many long-term investors are watching, because a short-term Fed decision may move markets for days, but debt, inflation, and currency confidence can shape markets for years. And that is why the smartest investors are not only watching the Fed, they are watching what the Fed is fighting against: the economy, inflation, the bond market, and the growing cost of borrowing, because eventually, every central bank faces the same challenge: how do you control inflation without damaging the financial system? That balance is where opportunities and risks are created, and gold and silver investors are standing directly in the middle of that battle. So as the Federal Reserve prepares to speak, remember this: the loudest signal will be the headline, but the most important signal may be hidden underneath: the language, the expectations. Those two explanations sound similar, but for gold and silver, they can create completely different reactions. If the Fed holds rates and signals confidence that inflation is moving lower, investors may begin pricing in future rate cuts. And when markets expect lower rates, the pressure on precious metals can begin to ease. But if the Fed holds rates while warning that inflation remains a threat, the market may interpret that as rates are staying higher for longer, and that message can support the dollar while putting pressure on gold and silver. The second scenario is a surprise rate increase. This is the scenario that creates the most immediate fear. A surprise hike tells markets something important. It says the Federal Reserve believes inflation is still dangerous enough to require more pressure on the economy. The first reaction could be a stronger dollar. Bond yields could rise, and precious metals could experience sudden selling. But here is where experienced investors think differently. They know the first reaction is not always the final reaction. Markets often move emotionally before they move logically. A sharp decline in gold after a hawkish Fed decision may not necessarily mean the long-term story has changed. Sometimes it simply means investors are adjusting to new information. And that is why understanding the second layer matters: the bond market. Because while many people watch gold prices directly, institutional investors often watch something else first: treasury yields. The bond market is one of the most powerful forces affecting precious metals. When investors believe interest rates will remain high, bond yields usually rise. Higher yields make bonds more attractive, and that can reduce demand for gold. But when yields begin falling, the opposite can happen. Investors start searching for protection. They begin looking again at assets that are not dependent on government promises. And that is where gold has historically played a unique role. Gold is not a company. It is not a government bond. It cannot print more supply with a decision from a central bank. That is exactly why investors turn toward it during periods of uncertainty. But there is another piece of this puzzle that many people underestimate: the US dollar. Because gold is priced globally in dollars. When the dollar strengthens, gold often faces pressure because it becomes more expensive for buyers using other currencies. When the dollar weakens, gold often becomes more attractive internationally. This creates a constant battle. The Federal Reserve influences interest rates, influence bond yields. Bond yields influence the dollar, and the dollar influences gold. A single decision inside the Federal Reserve can travel through the entire financial system. But while short-term traders focus on these daily movements, the largest investors in the world are watching something much bigger. They are watching the structure underneath the system. They are watching debt. The United States government now carries a debt burden measured in tens of trillions of dollars, and every year the cost of servicing that debt becomes larger. This creates a difficult situation. Higher interest rates help fight inflation, but higher rates also increase borrowing costs. The longer rates remain elevated, the more expensive government debt becomes. And this is the long-term argument many gold investors focus on. They believe there is a limit to how long governments can operate under extremely high borrowing costs. Eventually, economic pressure can force policymakers to choose between different risks, fight inflation aggressively, or protect financial stability. That is the tension beneath every major Fed decision. And that is where gold has historically played a unique role. Gold is not a company. It is not a government bond. It cannot print more supply with a decision from a central bank. That is exactly why investors turn toward it during periods of uncertainty. But there is another piece of this puzzle that many people underestimate: the US dollar. Because gold is priced globally in dollars. When the dollar strengthens, gold often faces pressure because it becomes more expensive for buyers using other currencies. When the dollar weakens, gold often becomes more attractive internationally. This creates a constant battle. The Federal Reserve influences interest rates, influence bond yields. Bond yields influence the dollar, and the dollar influences gold. A single decision inside the Federal Reserve can travel through the entire financial system. The world faced high inflation, energy shocks, rising uncertainty, and declining confidence in traditional financial systems. The Federal Reserve responded with aggressive rate increases. Many investors became discouraged. Gold experienced extreme volatility. There were moments when people believed the gold story was over, but those who looked beyond the short-term fear saw a much larger transformation taking place. Gold moved from being ignored by many investors to becoming one of the strongest performing assets of that decade. The lesson was not that gold always goes up. The lesson was something more important. Major financial shifts often begin when confidence is lowest. The same pattern appeared during other periods of uncertainty. During financial crises, investors often search for assets they believe can protect purchasing power. That does not mean every decline is a buying opportunity. It does not mean prices cannot fall further. It means investors who understand history know that fear can create the most emotional decisions, and emotional decisions are often the most expensive ones. Right now, the Federal Reserve is fighting inflation. Markets are watching rates. Investors are watching bonds. Countries are watching debt, and central banks are watching gold. The question is not simply where gold and silver move tomorrow. The bigger question is what financial environment is being created for the years ahead, because the short-term market is a battle, but the long-term forces underneath it are the real story. The most dangerous moment for a gold or silver investor is not always when the market falls. Sometimes the most dangerous moment is when fear takes control. Because throughout financial history, the biggest losses have rarely come from people who misunderstood an asset. They have come from people who understood the asset, but abandoned their strategy at the exact moment emotions became strongest. And that is why investor psychology matters more than most people realize. A Federal Reserve decision creates the perfect environment for emotional mistakes. The headlines become louder, the price movements become faster, every financial channel starts broadcasting predictions, every chart turns red or green, and suddenly investors who spent months thinking logically begin making decisions within minutes. They sell because they are afraid, they buy because they are excited, they chase the crowd. And the crowd is often the most dangerous place to be. This is the pattern that repeats again and again. When markets rise, people become confident. They believe the trend will continue forever. When markets fall, they believe the entire story has changed. But successful investors understand something different. A price movement is not always a change in reality. Sometimes it is simply a change in emotion. And this is especially important for precious metals, because gold and silver are not like ordinary investments. They are often owned because people are concerned about the future. They are owned because investors want protection. They are owned because people understand that financial systems can change. So when uncertainty arrives, the very thing that caused people to buy metals can also test their patience: fear. The biggest mistake during Fed volatility, the biggest mistake investors make during a Federal Reserve event is simple. They confuse short-term noise with long-term information. A Fed announcement can create violent moves. Gold can rise sharply in 1 hour and reverse the next. Silver can fall suddenly because traders react to one sentence from the chairman. The market can look chaotic. But chaos is not always a signal. Sometimes it is simply the market trying to process new information. Professional investors understand this. They do not only ask, what happened today? They ask, has the long-term reason for owning this asset changed? That is a completely different question. A single interest rate decision does not erase years of monetary policy. A single inflation report does not eliminate government debt. A single market reaction does not change the fact that central banks around the world continue to think about reserve protection. This does not mean gold and silver cannot fall. They can. It does not mean investors should ignore risk. They should not, people. But it does mean emotional decisions during extreme volatility can become expensive. Because the investor who sells during maximum fear often discovers something painful. The market does not wait for them to feel comfortable before recovering. History shows this repeatedly. The people who wait for certainty often arrive after the opportunity has already passed. 3 possible future scenarios. Wahom.fos be no future with certainty. But investors can prepare by understanding the possible paths. There are 3 major scenarios that could develop. Scenario 1, inflation falls and the Fed becomes more flexible. In this scenario, inflation continues cooling, economic growth slows, the Federal Reserve gains confidence that price pressures are moving in the right direction. The possibility of lower interest rates increases. If this happens, bond yields could decline, the dollar could weaken, and that environment could become supportive for gold and silver. Why? Because lower rates reduce the opportunity cost of holding metals. Investors begin searching for assets that can preserve purchasing power. This scenario would represent a softer landing. The economy slows but avoids a major crisis. For precious metals, it could create a favorable environment. Scenario 2. Inflation remains stubborn. This is the scenario many investors fear. Inflation refuses to disappear, energy prices rise, economic data remains strong, the Federal Reserve keeps rates higher for longer. In this environment, gold and silver could face continued pressure in the short term. The dollar could remain strong. Bond yields could stay elevated. Many investors may become frustrated. But this scenario also creates an important question. How long can restrictive monetary policy continue while debt levels remain high? Because the longer the battle continues, the more difficult the balance becomes. Scenario 3, a financial shock changes everything. The third scenario is the one nobody wants, but every serious investor considers. A major economic event, a credit problem, a banking issue, a geopolitical shock, something that forces markets to suddenly rethink risk. In that environment, investors often search for assets outside the traditional financial system, and historically, gold has often benefited when confidence in financial stability weakens. Again, this does not guarantee a specific price. Markets never work that simply, but it explains why investors continue to watch precious metals during uncertain periods. And this brings us to the bigger lesson. The Federal Reserve meeting is important. The inflation data matters, interest rates matter, but the greatest advantage an investor can have is not a perfect prediction. It is understanding. Because predictions can fail. Markets can surprise everyone, but knowledge gives you something more valuable: preparation. The average investor sees a headline. The prepared investor sees a pattern. The average investor sees a red number. The prepared investor asks why it happened. The average investor reacts emotionally. The prepared investor thinks strategically. And that difference is often what separates successful long-term investors from everyone else. Because wealth is not only built during easy times, it is protected during difficult times. For decades, investors have faced moments exactly like this. Moments when uncertainty was high. Moments when experts disagreed. Moments when fear dominated the conversation. And every generation faced the same temptation: to believe that this time is different, to believe that the short-term storm is the entire story. But history teaches a different lesson. Storms pass. Markets adjust. Economic cycles change. And investors who maintain discipline often find opportunities that others miss. So as the Federal Reserve prepares to speak, remember the bigger picture. Watch the decision, watch inflation, watch the bond market, watch the dollar, but also watch your own emotions, because the biggest threat to your wealth is not always the market. Sometimes it is the decision you make while the market is frightening you. Do not allow one headline to control your financial future. Do not allow one bad day to erase years of patience. Understand what is happening, study the forces behind the move, and make decisions with knowledge instead of fear. Because in the end, the greatest advantage is not knowing exactly what happens tomorrow. The greatest advantage is being prepared for whatever happens. If you own gold or silver, I want to hear your perspective. Do you believe the Federal Reserve will eventually have to lower rates because of economic pressure and debt? Or do you believe inflation will force rates higher for longer? Share your thoughts in the comments. Many investors watching this video are facing the same questions, and your experience could help someone else make a more informed decision. And if this video helped you understand the forces moving gold, silver, and the global financial system in a clear way, subscribe. Because the next Federal Reserve decision, the next inflation report, and the next major market shift will create new questions, and we will be here to break them down. Not with panic, not with hype, but with understanding. Because when the world reacts emotionally, the investors who stay calm are the ones who see the clearest. The storm may arrive, the headlines may become louder, the markets may move violently, but those who understand the bigger picture are never truly caught by surprise. And that understanding may be the most valuable asset you can own.